A brief introduction. My name's Mark Borzomato. I'm the Chief Executive of Merseyside Special Investment Fund. We are a regional investor supporting Liverpool City region based SMEs with a variety of debt and equity investment products. Personally, I've been involved in the investment side now for about 15 years, and prior to that I was an advisor. I've also spent time in industry trying to secure finance, and also conducted my own MBO. So Mark put the pressure on me of a reasonably broad heading to discuss the support that may be able to help businesses access commercial and other debt and equity finance. Bit of a tough and broad subject to cover in 15 minutes, so I'm afraid only a single slide from me. We know death by PowerPoint. I suppose one of the things that I is often quoted to me, and I'm aware of, and it does predate the pandemic, is businesses looking for growth funding, where do they turn? And the statistic that used to scare me was, of all the businesses looking for growth funding, a third expect the answer to be no, and therefore don't speak to anyone. A third don't know who to speak to, and only a third of them look to therefore pursue looking for growth finance. I think what I'd like to talk through therefore is just reinforce some of the various previous speakers' comments and build it into an element of it that I'm referring to on the slide as a funding pyramid. I think on the actual pyramid, Laura already commented earlier, most businesses will have cash in the business already. It could potentially be locked up. It could need some change in approach to release that cash availability, but it is yours to control. It comes at no cost. And is likely the simplest form of finance that you've got in the business. That doesn't mean the process of unlocking it is simple, but it means that it's in your gift. And I think moving that's kind of the base of the pyramid that I've put there, because it is available to all. But then we move through the pyramid, and there are various other debt and equity type offerings. So I think the first thing to understand is quite how your investor, how your funder would potentially get the return on their investment, and what is the difference between the debt and equity offerings. So the debt offerings in there typically are taking their returns by repayment and interest. They would generally look for security in a business to be able to take security over various assets in the business, and would tend to be serviced out of the cash generation of the business. So the ability to generate cash would therefore be a reasonably likely requirement for a debt lend. Equity elements, on the other hand, tend to take a stake in the business, take an actual shareholding in the business, and their ultimate gain would then come from the sale of shares in the future. The likelihood therefore is they're looking for an increase in value of the business rather than looking at the short-term cash generation of the business, likely to be less focused on servicing, and likely to be more projection-led. They are keen to see a business which is looking to grow, which has an ability to increase the value of the company. It tends to be higher risk. It would be unlikely, given that they are looking to support business growth, there may be limited security or limited short-term cash flow, such that it would be higher risk. And as a result of that, they do tend to look for greater return, as I've put on the slide there. The cost of the money is higher. but it's looking to understand the growth profile of the business. As a result of that, there are fewer equity investments, and one of the reasons why it's a pyramid, it's not that one is better than the other, but it's more that there are generally fewer equity investments as they look for those growth businesses. And the diligence that an equity investor would look to do, the support to make an investment decision would likely be more thorough. It would be based on diligence around the commercial opportunity for a business. Can a business grow? Is the management team capable of delivering that growth? Is it in a market where that growth is possible? And so the growth profile of the investee businesses is different. Businesses which can support debt, it may not be that equity is the right vehicle for them. It generally, therefore, tends to be a tougher investment process with an increased degree of diligence than typical debt lends. And I think the other element of it is that there is greater involvement and support potentially from an equity investor. They are very much focused on supporting the business growth. Equity comes in a few different guises that we've all become a little bit more familiar with lately. So equity investment may come from crowdfunding sources, it may come from angel investment sources, or it may come from institutional investments such as MSIF. And I think one of the observations I would make on that is that crowdfunding is usually a cheaper form of equity. They would require a smaller stake in the business than typical institutional investors may look for. So there may be a cost benefit in there, but would normally tend to be less involved than an angel or institutional investor who are looking to support businesses to make sure they capitalize on their fundraising opportunity, their growth opportunities moving forward. I think the overall element of this, though, is there are just different funding avenues available for different stages of business. It will depend on the current cash generation of the business, the growth potential of the business, and the owner's appetite of what they ultimately want to do with the business moving forward and where they want to take it. I think the really important thing is to speak to advisors and funders and understand what options are right for each individual business. I think it's important in the current climate to also highlight funding is still available. There are still equity investments available. There is still the debt market offering at the moment, and it is important that businesses are aware of who they can actually approach and consider the overall options that are available to them. Speaking to advisors, it'd be certainly a positive just to understand the differences of the various products. Ultimately, it's about what an individual business is looking for.